Hi, my name is Carrie Barkley, and this is a case covering private placement memorandums, due diligence, term sheets, and regulations prepared for Dr. Shiroki. A private placement memorandum is a key component of any offering. It is used for companies that are seeking capital and details the terms of the investment, requirements of the investor, and the proper disclaimers and disclosures related to the business and the equity. The PPM lists the risk factors so everyone reading the PPM can understand the company's risks. This becomes important if bankruptcy becomes a viable option in the future. To an investor, the PPM is a document full of information. To the issuer, a PPM is a sales document. They want the PPM to make their company look good to investors. To managers, the PPM is a summary of the business plan or how the company is to be conducted. The private placement memorandum should answer the question, what are the terms of the deal? There are both pros and cons that private placements offer small businesses over IPOs. Private placements are less expensive than an IPO because of the fact that they do not require the assistance of brokers or underwriters. Also, private placement enables the business to handpick investors with similar goals and interests as the company. There are some disadvantages to private placements as well. It may be difficult to find an investor. In addition, privately placed securities are often sold below their market value, where they will have to renounce more equity since investors propose great risk when assuming an illiquid position. The term due diligence first came into common use as a result of the United States Securities Act of 1933. Due diligence was included in Section 11, where the broker or dealers have to enclose investors with adequate information with respect to the purchase of securities. As long as the broker or dealers exercised due diligence in their investigations, they would not be held liable for non-disclosure of information that was not discovered in the process of that investigation. All parties involved in an acquisition must guarantee that the financial information given is current and accurate. Due diligence is a term used for a number of concepts involving either an investigation of a business or person prior to signing a contract. This investigation is usually voluntary and involves an acquirer evaluating the company's assets for acquisition. Financial due diligence is important for many people involved in a merger or acquisition, such as the buyer, seller, and lender. There are three areas of financial due diligence which are the last obstacles before successfully financing a company. The first is an explanation of how you plan to use the funds. The second is an explanation of your business model and budgets. And the third is a legal review. From a buyer's point of view, the financial statements about a business you are looking to acquire must reflect reality. Financial due diligence can help to identify and focus attention of the factors in the business that will be critical to its future success. Financial due diligence focuses on many subjects such as the purchase price adjustments, financial abnormalities, adequacy of existing management financial information, accounting issues, and etc. From a seller's view, due diligence can benefit them by making sure they receive the correct amount of money, and not any less. Transparent financial statements provide buyers with information about the business and the nature of its cash flows. Lenders are also active participants in a merger or acquisition. They are usually most concerned with the target business's quality of collateral. Financial due diligence can help assess the collateral supporting a loan, as well as the reporting systems that produce the information. All in all, due diligence is a simple idea leading to making better and more informed decisions. All companies and organizations exercise the use of due diligence and can benefit from it. A term sheet is a document prepared by venture capitalists that defines the key terms of a proposed investment. The components of a term sheet are different for every deal. However, there are some basics that need to be covered in every term sheet. The investment amount must be laid out and extremely clear. The type of security must be discussed so the investor knows what type of stock is being issued. The three most common stocks discussed in a term sheet are common stock, preferred stock, and participating preferred stock. Warrant coverage is also usually included in a term sheet. Pre-money valuation is a clear understanding of the company's valuation prior to the new investment, and ownership is the next section that is usually discussed. New investor ownership is calculated by dividing the new investment dollars by the post-money valuation. The next section usually deals with the different management options. Distribution, which entails the investor's liquidation preferences, is an important part of a term sheet that needs to be well thought out and understood by both parties. Governance of the board post-investment is an important component of investment as well. Consent requirements are where the term sheet starts wrapping up. This section of the term sheet is associated with minority stakes that provide a list of what-if situations that will require approval of the investor. The exit part of the term sheet is where all parties involved have a clear understanding of the timing of the investment. There is another section that contains any information that does not fit in the above categories that may be of importance to all parties involved. A company can make a term sheet as complicated as it needs to be to ensure that both parties are on the same page and agree on the terms set forth, since all investors will want different things. The term sheet basically outlines the proposed proposition and as well as indicates the value of the transaction as a whole. The private placement memorandum has the advantage of reducing transactional and ongoing costs because of its exemption from many of the extensive federal and state registration and reporting requirements. To qualify for a private placement, a company must structure the transaction with available exemptions such as Section 4.2, Section 3A11, and on the Regulation D in the Securities Act of 1933. Private placement memorandums take into consideration the SEC Regulation D exemption rules 504, 505, and 506. These rules usually refer to solicitation and advertising to promote the offering, selling only to accredited investors, and the resale of securities. Section 4.2 is an exemption for transactions by an issuer not involving a public offering. Some guidelines for this exemption include keeping the number of offerees as small as possible, then offering should be limited to insiders, and the prospective investor should be provided with at least a set of financial statements. Section 3A11 is an exemption for any security which is part of an issue offered and sold only to persons resident within a single state by an issuer which is resident and doing business within such state. All in all, the main point of this rule is ensuring that the offering is truly an intrastate offering, which means the securities offering can only be purchased in the state which it was issued. Rule 504 provides an exemption for the offer and sale of up to $1 million of securities in a 12-month period. A company can use this exemption as long as it's not subject to Exchange Act reporting requirements. Also, these securities may be sold to an unlimited number of accredited investors and up to 35 unaccredited investors who do not need to meet certain standards that might have to be met to invest in other securities. Rule 505 provides an exemption for offers and sales of securities that add up to $5 million in any 12-month period. Purchases of this category must buy for investment purposes only and not for resale. These securities are restricted in that the investors may not sell the securities for a minimum of 2 years without registering the transaction. Rule 506 is provided for companies that can meet certain standards. These standards include the ability to raise an unlimited amount of capital, do not use general solicitation or advertising to market the securities, the sales of securities can be sold to an unlimited number of accredited investors and up to 35 other purchasers, and unlike Rule 505, all non-accredited investors must have exceptional knowledge and experience in financial business matters. When discussing the legal implications of due diligence, a company can be prosecuted for not conducting proper due diligence. So, if due diligence is conducted properly, it can serve as a strong legal defense to third-party claims after the transaction closes. It can also reduce legal issues by informing the investor of potential liabilities that can diminish in various ways prior to closing the transaction. A term sheet has a variety of protective clauses for the venture capitalist that can reduce valuation for the entrepreneur. This is why it is important to have an experienced attorney look over and negotiate a company's term sheet. Thank you for your time.